got Mayuresh Joshi, Head of Research at MarketSmith India, as well as Avinash Gorakhkar, Founder and Head Research at Avinash Mentors Research. Both of you gentlemen, welcome to this conversation. I wanted to ask you, Mayuresh, first, on IndusInd Bank. Last quarter we believed that this would have been the end of the problem era and maybe the new CEO will come in with a new book entirely. You are seeing more provisioning against microfinance loans now. How do you make sense of these numbers?
Very good afternoon. I think two aspects. One, I think in terms of the excess provisioning that IndusInd Bank has done onto its books, I think they are trying to protect their balance sheet to a large extent, trying to create a clean slate in terms of all the woes that they have probably gone through in the previous few quarters. And therefore, as they head into the second half, I think they relatively want to start off with a cleaner slate. The second aspect in terms of the asset quality itself, I think you've seen improvement out there, not just for IndusInd, but also for the two major banks, HDFC and ICICI, which clearly indicates that the risk-weighted assets and the weightage that the management have probably given in terms of the riskier loans in the system, that have probably come off to a large extent. And therefore, I think the kind of stress in terms of sluggishness that the economy was probably going through till the second half, whether it was vehicle loans, whether it was MSMEs, SMEs, microfinance, there I think there should be some element of respite as we head into the second half. And therefore, I think management commentary shall do the trick. The NIM compression that you've probably seen, in my opinion, again, I think this should be the last quarter where I think the NIMs might remain compressed. You should see gradual stabilization and improvement for the bank and the system as a whole as we head into the second.
Understood. Got that, Mayuresh. Avinash, let me go across to you. ICICI Bank said that this quarter has been a poor one as far as treasury income is concerned, and that is, of course, weighed on their overall profit growth, income growth as well. Wanted to get a sense about what the quarters ahead look like. Firstly, what is your view of the current quarter numbers? And secondly, what do you expect for the rest of the financial year?
No, I think, Rishi, I believe the second half would be significantly better because I think, with these GST cuts announced, a lot of consumption is going to be driven by credit growth. And I think the bank has got all its growth engines ready for the, upcoming festive season. My sense is that this is definitely a disappointing quarter. Markets expected ICICI Bank to do a lot better, but I think one can always give it a benefit of doubt because looking at the kind of growth in the economy, I think definitely it's not a bad performance, but I think something better would have always been appreciated. So probably in the week ahead, you could expect a softer opening. But my sense is that second half definitely looks to be more optimistic, and I think almost all the businesses, the core banking business, the insurance business, the asset management business, all of them seem to be doing well. So I think, giving it a benefit of doubt, I think numbers are definitely better. I think if you look at HDFC Bank numbers, if you take out the SDB financials, one-off, then I think numbers have not been all that great. So compared to HDFC Bank, I would be more optimistic and positive on ICICI Bank.
All right. Hold on, gentlemen. We're getting some comments from the HDFC Bank management. They're hosting a media call that's going on right now. And the comment that they're making is that FY27, they're expecting to grow above industry. Now, this year, that has not been the case, right? Advances growth has been actually slower. And I wanted to ask you, Mayuresh, HDFC Bank results. Yes, the margin compression is a problem. Having said that, growth is not sort of blockbuster. Understandably so, because their book is larger than most other private sector banks, even their nearest competitor, ICICI Bank. It's literally about 15 lakh crore higher or thereabouts. I think 13 lakh crore larger than ICICI. Do you think that a 10% or a sub 10% growth is optimal for HDFC Bank size?
No, Vishwanath. I think the base effect, as you pointed out, I think will clearly indicate that the entire system has gone through a sluggish phase as far as Q2 is concerned. Now, as Avinash pointed out, and as all of us are aware, with GST rationalization and the expectation in terms of more pickup that is probably expected, both in terms of consumer durable and discretionary loans, as we head into the second half, I think it will be interesting to observe how the advances will probably map out. But I think the more interesting aspect, Vishwanath, will be the deposit growth aspect, because ultimately I think the credit deposit ratios, if they have to improve significantly, the deposit growth for the industry as a whole also should be better than what we are probably expecting at this juncture. Enable the bank to probably make use of the entire tier 1 capital that they probably have on their books, and expansion of return ratios as one really expects through better advance allocation. Having said that, I think the excess provisioning that HDFC Bank has probably done onto their books on a year-on-year basis, I think I'd like to have more granular details on why that has probably happened. And what about the SMA1, SMA2 book that we are talking about for the bank itself? Which brings us to the greater question in terms of the system as a whole. As we head into the second half, how much of unsecured lending will probably happen in the system, and does that have some element of an impact as far as provisioning and asset quality concerned?
You know, interestingly, Mayuresh, this is a question that ICICI Bank's management answered in their con call just a little while ago, and the point that they were making is that you are likely to see more unsecured lending growth now. This is something that Axis Bank said as well, that the asset quality has actually improved, and therefore they are pushing the credit card as well as personal loan business. Avinash, let me come to you about these points, right? Like, so there is this repricing of deposits that is still working its way through the system. Until that is completed, NIM sort of contraction doesn't really help. There will be a boost from that CRR cut that the RBI has given in the coming quarter. So cost of funds will come down, and thereby your margins will look slightly better. But to your mind, how soon do you think we can come out of this compression phase on the net interest margin front across all banks?
No, I think my sense is, Vishy, the December quarter could definitely see a little bit of improvement, but the January to March quarter, I think you would see a good bump up in the margins for the banks. And I think, as you rightly mentioned, a little more flexibility has been given in terms of higher liquidity. But I think the Jan to March quarter could be a more robust quarter. And I think, as you said, most of the banks are now gearing up for higher credit growth. October to December would be the first signal, and I think January to March, hopefully, if the trend continues. We've already seen consumption levels across categories like FMCG, consumer durables, consumer appliances, autos. These are segments where a lot of bank credit is going to come in. So I think October to December would be a good beginning to start with, to see some improvement. But I think Jan to March quarter could possibly see a bigger improvement. So, the banking sector as a whole, definitely we are structurally positive. We expect a strong second half. And I think most of the private sector banks like, ICICI Bank in the top order, then HDFC Bank, definitely should do. And I think I'm pretty surprised how Federal Bank showed a dip in the profits, because we were expecting a number to, in fact, get better. But I think probably provisions were up. But otherwise, Federal Bank has been a good performer. But maybe in this quarter, I think it possibly, provided a little more, and that definitely hurt its bottom line.
Yeah, no, I actually wanted to pick up Federal Bank with you guys. Mayuresh, the point that the management made, which is that last year we were not doing accelerated provisioning against unsecured loans. This is something that we're doing this year, and by Q4 that impact should sort of play out. But that would mean that 2 more quarters of you seeing this discrepancy between provisioning this year and the provisioning last year. Do you agree with the point of view that maybe comparing it year on year is not appropriate? Because to me personally, I'll tell you what I feel. To me personally, I think every year you're going to have some or the other accounting adjustments. This is just common business as usual if you're going to run a bank. So is that a fair comparison year on year versus quarter on quarter? Mayuresh, how are you looking at it?
So seems fair, Vishwanath. But again, I think the most ideal way of looking this is both on a YOY and a quarter-on-quarter basis, because that is where I think ultimately the test, the proof of the pudding probably comes out. Is it a year-on-year improvement that you're probably seeing, and were there situations or conditions that were different a year ago, and whether there is improvement on a quarter-on-quarter basis as well. Now we all know, as an example, as Avinash was also mentioning, I think as deposits will get repriced over the next 2 quarters, you will see NIM stability coming through. But as that happens, I think what happens in Federal Bank's case in particular is that a lot of the remittance dependency that they've probably got, almost 24-25% of their net term and CASA deposits probably stay in line with a lot of remittances happening in from the Middle East. How does that probably keep on faring is something to be watched out for. The second aspect, obviously, is that overall performance, including the net interest income, was very modest as we speak. There might be some element of tailwinds that you're probably seeing in terms of the treasury book or the non-interest income as we see it. But again, I think in terms of their pre-provisioning profits, in terms of expectations of asset quality, in terms of NIMs, it largely was a soft quarter for Federal Bank. So it really now depends on how the bank probably ramps up its Q3 numbers to probably give the street some element of confidence. No two ways in terms of where valuations stack up for Federal Bank within the mid-cap private space.
All right, Maherish, thank you so much for taking us through your thoughts, as well as Avinash Gorashkar. Both you gentlemen, thank you so much for talking to us and discussing your thoughts on the bank results.